Good morning. I am Rohit Usha Pagare, working in the Department of Accountancy. Welcome to you all for Accounting Standard 10, Property, Plant and Equipment. Earlier, this Accounting Standard 10 was designated as Accounting for Fixed Assets, but now we have done away with the Accounting for Fixed Assets and we have a full-fledged new accounting standard titled Property, Plant and Equipment. What are property, plant and equipments? Property, plants and equipments are tangible assets. They are fixed assets. Now, what do you mean by tangible assets? Tangible assets are those items which you can see, feel and touch. In the same way, you can see, feel and touch your property, plant and equipment. That's why in the very first line we have termed that property, plant and equipments are fixed assets. These fixed assets are tangible in nature, unlike intangible property dealt in by AS 26. Now the definition. Definition of property, plant and equipment. Property, plant and equipment are tangible items that are held for use in production or supply of goods or services, for rental to others, or for administrative purposes. See, now in this point A, three different purposes of property, plant and equipment have been clearly mentioned. What are they? We'll start with the line are held for use in number one reason production or supply of goods or services. You are not going to produce all the time, or you are not going to supply all the time, or either you will produce or you will supply. So the number one use is in production or supply of goods or services. Second reason is for rental to others. If you are not producing, if you are not selling, still you can give it on rental to others. And the last use is or for administrative purposes. Next point B are expected to be held during more than a period of 12 months. If you sell an asset within a period of 12 months, you are not going to call it as a fixed asset. For meeting the requirements of a fixed asset, your asset must be there with the organization for a period of more than 12 months. C. Not held for sale in an ordinary course of business. You don't sell off your plant and machinery as you sell your inventories, so you are not going to sell it off in the ordinary course of business. Objectives. The objective of this accounting standard is to prescribe an accounting treatment for property, plant and equipment so as to ensure the financial statement user that he has the information regarding the investment made by the enterprise in the property, plant and equipment and the changes in such investment. Scope. For the purpose of the scope, I have divided the scope into two distinct halves. First, this accounting standard is applicable to, and second, this accounting standard is not applicable to. If we clearly have an idea that where this accounting standard is not applicable, we can apply this accounting standard at its appropriate place. So I have divided it into two distinct halves. First, where it is not applicable, and second, where it is applicable. As this list of the items included in the property, plant and equipment is exhaustive, it's never ending, so it's better we study first where this accounting standard is not applicable. The crying dolphin represents the area where this accounting standard is not applicable, and this happy jack represents the area where this accounting standard is applicable. Now, where does this accounting standard does not apply? This accounting standard does not apply to biological assets other than bearer assets. What do you mean by biological assets? Biological assets are living plant and living animals. So you are not going to make accounting standard applicable to me, nor you are going to make this accounting standard applicable to yourself, because we all are living human beings. We are living human beings. That is, we are living animals. Okay. Then living plant. You are not going to apply this to a living plant even. Then next, where else you're not going to make it apply is agricultural activity. Now, what do you mean by agricultural activity? Agricultural activity means transformation and harvest of biological asset for sale or for conversion of agricultural produce into additional biological asset. It means either you produce a agricultural product for selling or you produce an additional agricultural product, but it is relating to agriculture. Okay, so it is why it is called as agricultural activity. Then next, wasting asset. Further, this accounting standard is proclaimed to be inapplicable to wasting assets. Wasting assets includes mineral rights, expenditure on exploration for and extraction of mineral oil, natural gas, and similar non-regenerative resources. It means those resources which will be replenishing with the passage of time or with the extraction or with the usage. To these asset again AS10 is not applicable. Continuing ahead the scope, let us venture into the area where this accounting standard is applicable. This accounting standard firstly is applicable to all properties, plant and equipment. For example, plant and machinery, land and building, motor car, equipment, etc. However, it is not applicable to those assets for which a different accounting standard is applicable. I'll give an example. An example is leasehold properties. For a leasehold property, AS19 is there, so accounting standard 10 won't be made applicable to it. Barring these small exceptions, this accounting standard is applicable to almost all properties, plant and equipment. Secondly, where it is applicable is your bearer asset. Now, what do you mean by bearer asset? See, I tell you, it's a very close resemblance between a bearer asset and a plant, a living plant. But where it differs in the following 3 points: A, B, and C. If A, B, and C are satisfied, then the bearing plant will be called as a property, plant and equipment. Which are these conditions? A is used in the production or supply of agricultural produce. My this plant, this particular plant, or the bearer, to be very specific, this bearer plant, this bearer asset will be used in the production or supply of agricultural produce. Which is the second point. B is expected to be a produce for more than a period of how much? 12 months, obviously. In accounts for fixed or for long term, we call it 12 months. So, is expected to be a produce for more than a period of 12 months. C has remote likelihood of being sold as agricultural produce except incidental scrap sales. I am not going to sell this plant off. I am not going to sell the hen off which is giving me a golden egg. No, I am not a fool. So this plant is not going to be sold. This bearer asset, now whenever I say plant over here in this particular slide, kindly make resemblance of bearer asset. So this bearer assets I am not going to sell it off in a year or in a day or like an agricultural produce. Have you seen an intelligent fellow who will sell off a mango tree along with the mangoes? No, no one is going to do this. If you meet a person like this, please let me know. I'll give you an example of bearer asset. My favorite example of bearer asset is a mango tree. Praniti Chopra also like to eat mangoes. Do you like to eat mangoes? Imagine that you are eating mango. So that mango is your agricultural produce. You are not going to keep the mango forever with you. You have purchased the mango or you are going to sell the mango. So the mango is your agricultural produce. Remember, I told you the bearer asset has a very close resemblance with agricultural produce. So here in our example, what is your agricultural produce? Is a mango. Who gives you mango? Obviously, correct, 100% correct. A genius fellow will answer it correctly, and it is a mango tree. So, a mango tree is going to give me mango. So, isn't the mango tree giving me or producing or supplying mangoes? That is an agricultural produce? Yes, it is supplying or producing. So, condition A is satisfied. What is condition A? Bearer plant is a plant that A is used in the production or supply of agricultural produce. B. Am I going to receive mango only in one season from the mango tree? No. I expect the mango tree to give me mangoes for coming generations. I don't want to end the mango tree so early. Let the mango tree prevail so that every season I'll eat mangoes. Condition B satisfied? Yes. Is expected to be produced for a period of more than 12 months. Then C has a remote likelihood of being sold as agricultural produce except for incidental scrap sales. Can you sell a mango tree along with the mangoes? No, you're not going to do it. I know you all are very intelligent. No one is going to sell off a tree for mangoes. No, you will sell the mangoes and keep the tree. So the next year again, when the season will come, you will eat some mangoes. Okay. My point over here is even in human sense, all these three conditions are satisfied by a mango tree. So your mango tree is a bearer asset liable as plant, property and equipment. Let's go for a rapid fire round and see some vital definition. First one to come up, carrying amount. Carrying amount is the amount at which an asset is recognized after deducting accumulated depreciation and accumulated impairment losses. So from an amount of an asset, when I subtract accumulated depreciation and accumulated impairment losses, the net figure will be termed as a carrying amount. Second definition, cost. Cost is the amount of cash or cash equivalent paid or the fair value of other consideration given to acquire an asset at the time of its acquisition or construction, or where applicable, the amount attributable to that asset when initially recognized in accordance with the specific requirement of other accounting standards. To tell you in short, cost is nothing but the price paid for the acquisition of the given asset. Third one, depreciable amount. Depreciable amount will be very useful for you because we will have to calculate depreciation in the later half of the accounting standard. So let us see this depreciable amount very carefully. Depreciable amount is the cost of an asset or the amount substituted for the cost less the residual value. So from the value of the asset or from the cost of an asset, when I subtract residual value, only the residual value, I get the depreciable amount. This depreciable amount must be systematically allotted over the estimated useful life of the asset. Means when I have purchased the asset for rupees 1,10,000 and the residual value is 10,000, my depreciable amount will be 1 lakh, that is 1 lakh 10, which is the value of the asset less residual value 10,000, I get rupees 1 lakh as depreciable amount. Now this depreciable amount must be allocated over the useful life of the asset. Say in a given example, the estimated useful life of the asset is 10 years. So I have to apportion this 1 lakh, or I am not a student of costing. If I have to allocate this 1 lakh over the expected useful life of the asset, which is 10 years, how will I do it? 1 lakh divided by 10 will give me 10,000. So the straight line method will tell me that I have to allocate rupees 10,000 each year. So at the end of the 10th year, that is when the expected useful life of the asset will come to an end, my 1 lakh will be recovered in full. What is my 1 lakh? My 1 lakh is the depreciable amount. How I have calculated it? From the value of the asset or the amount substituted for it, I have subtracted the residual value. Fourth one, fair value. Fair value is the amount for which an asset could be exchanged between knowledgeable, willing parties in an arm's length transaction. Fair value means what? It assumes some perfect market situation where both the buyers and sellers are equally competitive. No one is bound to purchase or no one is bound to sell. They are exercising their own free will, and likewise when they enter into a transaction and what the price is fixed, it is called as a fair value. My point over here is the fair value. Fair value means what? The amount for which an asset could be exchanged between knowledgeable willing parties in an arm's length transaction. Fifth definition, gross carrying amount. Gross carrying amount of an asset is the cost or the amount substituted for the cost in the books of the account without making any deduction for accumulated depreciation or accumulated impairment loss. Next definition is impairment loss. An impairment loss is the amount by which the carrying amount of an asset exceeds its recoverable amount. Means from the carrying amount of an asset, when I subtract its recoverable amount, I get the difference as impairment loss. The next definition is recoverable amount. Recoverable amount is the higher of the asset's net selling price and its value in use. Next definition is residual value. The residual value of an asset is the estimated amount that an enterprise would currently obtain from the disposal of an asset after deducting the expenses met for its disposal. if the assets were already of the age and in the condition expected at the end of its useful life. Last definition is useful life. A. The period over which an asset is expected to be available for use by an enterprise. B. A number of production of similar unit expected to be obtained from the asset by an enterprise is what is called as a useful life. Either it is expressed in terms of the length of years or the length of the life, or in terms of the units obtained or production. Recognition of property, plant and equipment. The cost of an item of property, plant and equipment should be recognized as an asset if and only if it satisfies A. It is probable that the future economic benefits associated with the item will flow to an enterprise. B. The cost of the item can be measured reliably. When both these conditions are satisfied, then only we will recognize the asset as a asset, that is a property, plant and equipment under AS 10. I will give you an example. Say for example, a plant and machinery is purchased for rupees 20 lakhs. It satisfies the recognition criteria. Which is the recognition criteria? First one, A1, future economic benefits will flow to the enterprise in the form of the capacity to produce goods using the machinery, sell them and earn profit. Similarly, its price can be measured reliably from the purchase invoice. Therefore, it qualifies to be recognized as property, plant and equipment. We are not going to record a toy in the books as property, plant and equipment because it doesn't satisfy any of the conditions listed above. Continuing the PPE, other points which must be looked after is spare parts and safety and environmental equipments. Now, when we are going to capitalize the spare parts, there are some three instances given to you. First spare parts is a minor spare parts. See, for the minor spare parts which we supply as a day-to-day maintenance of an asset, in that case we are not going to recognize it as a PPE. Instead, we will be treating it as an inventory and AS2 will be made applicable to it. Second instance of spare part is major spare parts. Say when we purchased a Xerox machine, an additional drum was given to us. Are we going to insert a Xerox machine drum to any other place? No. The Xerox machine drum is meant for the Xerox machine. So this is a major spare part. It should be capitalized and treated as PPE. Next, when a machine which we have purchased is intended for made to order purpose type of thing, in that case whatever are the spare parts being supplied should be capitalized, because when the asset is unique, its spares are also unique. When we are going to capitalize the asset, let us not forget to capitalize the spare parts also. Then comes the turn of safety and environmental equipment. The safety and environmental equipment will not pay or will not contribute directly for the economic benefit. It is not going to give you any economic benefit. For example, when you purchase a storage for storing dangerous chemical, that storage is not going to contribute for your economic well-being or the economic well-being of the organization. But remember, if you don't purchase this storage capacity or the storage unit, you are not going to get the permission to handle the dangerous chemicals. So likewise, safety and environmental equipment are treated as property, plant, and equipment are classified and capitalized in the balance sheet. Illustration on spare parts. In the earlier slides, we have seen the three instances of spare parts. First one was minor spare parts not to be capitalized. Second one was major spare parts to be capitalized. And the third one was made to order type of machine where the spare parts were capitalized. Okay, so now let us take examples on it so that things will be much clearer to you. Example number 2 is on minor spare parts. Small spare parts of the machinery are purchased at a cost of rupees 5,50,000 and stored by the entity. These are regularly issued whenever required by the maintenance department. The balance of the spare parts on the hand at the date of balance sheet was worth rupees 1,40,000. The consumed spare parts of rupees 4,10,000 should be shown as an expense, that is in the statement of profit and loss, and the balance of rupees 1,40,000 should be carried forward as an inventory. Its accounting to be dealt in by AS2. Now let us try to understand it. How much was the total value of the spare parts purchased? Minus spare part purchased were 5,50,000. From this 5,50,000, how much I have consumed is 4,10,000. So whatever I have consumed is my expense should be debited to the P&L. Now the balance of 1,40,000 remains. It has been repeatedly being told to you that minor spare parts are not to be capitalized in AS10. So what we are going to do to the balance of minor spare parts? To the balance of minor spare parts, we will be treating them as an inventory to be dealt in by accounting standard 2, valuation of inventories. Clear? Next example, major spare parts and standby equipment. Already told it to you that major spare parts and standardized equipments are to be capitalized. For example, Induga Limited purchased a machinery of rupees 2 lakhs together with a major spare parts worth rupees 25,000 not readily available in the market. Now what you are going to do to the spares? Yes, you are going to capitalize it. So your total value of machinery will be 2 lakh plus 25,000. It will be recognized in the balance sheet at 2 lakh 25,000. The third instance in the spare parts category was made to order type of machine. Whenever the made to order type of machine is given to us, that is the machine is absolutely as per our own unique requirement, whatever are the spares being supplied to us won't be used at any other place, so the spare part should also be capitalized. Here's the example. Z Limited purchases a made to order machine of rupees 10 lakhs and alongside also purchase spare parts worth rupees 12,000 which can be used only on this machine and not on any other machine. Advise Z Limited. It means along with the cost of the machine, the cost of the spare parts also should be capitalized, recognized at the carrying value. Thus, the total carrying value will be 10,000 plus 10 lakhs, sorry, not 10,000, 10 lakhs plus 12,000, that is 10 lakh 12,000. After the spare parts, next is safety and environmental equipment. I told you the safety and environmental equipment never add to the economic well-being of the organization, but they are those equipment failing to which you won't be allowed to take up the production line or go on with your main objective. Say for example, Nasik Chemical Manufacturing Limited may install new chemical handling processes to comply with environmental requirement for production and storage of dangerous chemical pertaining to the plant enhancements are recognized as an asset because without them the entity is unable to manufacture and sell chemicals. It is said that the initial recognition of the PPE must be at the cost. Now let us see what are the ingredients in the elements of cost. Depending upon the different transactions, that is either you have purchased or if you have exchanged. First let us see the purchase part of it. Now these are the instances when you have purchased a new asset. In that case, what will be the cost? The cost shall include number one, the purchase price which you will get from the invoice. To that you have to add import duties, non-refundable taxes, directly attributable cost, dismantling cost, site restoration cost. After adding up all these, we will be subtracting trade discount, less discount. The balance will be the cost of the asset under the transaction purchase. Then comes the exchange. Now when you have exchanged the shares for the new asset, in that case what will be the price of the new asset? The price of the new asset will be the value of the shares issued. It means whatever the shares we are going to issue will be the price of the asset. Now if the asset is acquired by issuing any other asset for consideration, that is a non-share form of transaction in exchange. In that case, first you should see whether the market value of the asset or the new asset coming in the business are clearly ascertainable. If the value of the new asset coming in the business is clearly ascertainable, in that case the value of the new asset will be the cost. And when the value of the new machine coming in, the fair value of the new machine coming in is not clearly ascertainable, in that case the value of the new machine will be the value of the asset given up. After the cost, the subsequent cost. Though the word cost is common, but for the purpose of AS10, the cost shall be denoted as something which arises in the initial stage, and subsequent cost is the something which arises in the latest half of the life of the asset. Now, we can also call the subsequent cost as repairs and renewals. When we should show it as expense to the debit of P&L, that is, we are not going to capitalize it. We are going to do it only if it is the item of day-to-day servicing. It is not going to add to the useful life of the asset. It is not going to increase the production capacity beyond the previous assessed capacity. And when we are going to capitalize it, we are going to capitalize it only when the repairs and renewals extend the useful life of the asset, or when the repairs and renewals increases the original assessed capacity of production. Before I take you through the slide of revaluation, let us try to recall what we have seen so far. Till so far, we have seen the definition and meaning of property, plant, and equipment, then definitions, some vital definitions which are necessary for studying the property, plant, and equipments. Along with that, we have seen the recognition criteria of an property, plant, and equipment, plus the spare and the treatment of the spare for the purpose of property, plant, and equipment. Now, let us go through the revaluation aspect. In the revaluation aspect, revaluation must be made with sufficient regularity so that to ensure no material difference between carrying amount and fair value at the end of reporting period. Importantly, a question may arise that what will happen to the accumulated depreciation which we have accumulated over the past so many years when the asset stands revalued. Interestingly, there are two methods of treating accumulated depreciation. They are reinstated proportionally method and elimination method. In reinstated proportionately method, the carrying amount of the asset is proportionately reinstated in such a way that after the revaluation, the carrying amount equals the revalued amount. In elimination method, elimination is done against the gross carrying amount and the net amount restated as the revalued amount. I'll give you put easy example in front of you so that you will come to know what will happen to depreciation, that is the accumulated depreciation when the assets stand revalued. Let us go ahead and see the def sorry see the not the definition, the illustration. Illustration for adjusting accumulated depreciation when the asset stands revalued. I have already explained it to you that there are two methods, proportionately reinstated method and the other one is elimination method. Let us solve the same sum by both the method. Here in our example, the cost of the asset is 2000, accumulated depreciation is 500, the carrying amount obviously will be 1500. Determine the accounting entries required to restate the carrying amount if the revalued amount of the asset is 2200. So now from 1500 to which amount we have to jump? We have to jump to rupees 2200, and this we are going to do by proportionately reinstated method and elimination method. Let us first go by the proportionately reinstated method. In the proportionately reinstated method, see how much was the cost. The original cost was 2000. I have to raise it to the new carrying amount, to the level of new carrying amount, which is rupees 2200, that is the revalued amount, which is rupees 2200, and I have to divide it by the old carrying amount, which is 1500. So 2000 multiplied by 2200 and divided by 1500 will give you 2933. Now from this cost, I have to subtract accumulated depreciation. As I have reinstated proportionally the cost, I have to reinstate proportionately the accumulated depreciation also. The formula will be the same, that is this time I have to multiply the depreciation by the new face value and divide it by the old carrying amount. So 500 will be multiplied by rupees 2200 divided by 1500 will give me 733. I'll repeat, for accumulated depreciation you have to multiply the old depreciation by the new revalued carrying amount and divide it by the old carrying amount. So when 500 is multiplied by 2200 and divided by 1500, we get a sum of rupees 7333. Now from rupees 2933, when I subtract 7333, I get the carrying amount, which is 2200, which in term is equal to the new revalued amount. So here we have proportionately reinstated the amounts. Next variant of this is elimination method. Elimination method is very easy. If you get a question on this for your exam, remember to score the whole marks. In this method, how much was my original amount? Original amount was 2000. Cost was 2000. And what is the new accumulated? New revalued, it's 2200. So the cost will be substituted at rupees 2200, against which I will be eliminating accumulated depreciation. So now accumulated depreciation is 0. I get the carrying amount rupees 2200.